Hey, what's up, investors? I'm Russ, and today we are joined by Professor Stephen Foerster from the Ivy Business School at Western University in London, Ontario. He's an award-winning author and investment historian who's about to debunk some major investing myths and share some pretty incredible stories that will make you a smarter investor. I'll have a link to his book, Trailblazers, Heroes, and Crooks, Stories to Make You a Smarter Investor, in the video description below. And from that book, we'll uncover Ronaldo's supposed $4 billion Coca-Cola incident and dive into some lessons from Warren Buffett and even Sir Isaac Newton. And a heads up, because yours truly completely flubbed the camera settings, so for the duration of the interview, I have a nice little white camera focus box over my face. But as they say, the show must go on, so get yourself ready for some great investing insights from Professor Stephen Foerster. So Professor Stephen Foerster, can we call you Steve?
Absolutely, Russ.
Yes, we got you. So thank you for stopping on by the channel and talking about your book.
My pleasure.
I'm going to say that I really enjoyed it, and what really got me about your book was story. And I love stories. I think stories are some of the best ways that we can learn. I'm a big fan of the book Sapiens by Yuval Noah Harari. And in it, he kind of talks about what distinguishes us from the rest of all the things living on this planet is our ability to tell story and to use story to convey information and teach. I love that about your book. And I would highly recommend, if you want a good, it could even be a bathroom reader. I love your short, punchy chapters. I mean, you can just open it, start at any chapter, and it's just very, very well put together. So tell us a little bit about your background and maybe what inspired you to write this book.
Sure. I'm a finance professor in Canada at University of Western Ontario, which is in London, Ontario. We chatted a little bit about some great hockey teams we have that have been feeders to the Chicago Blackhawks. So that's our connection here. I've been doing research on capital markets, on stocks and investments for almost 4 decades now. My previous book in 2021 with Andrew Lowe was called In Pursuit of the Perfect Portfolio, where we interviewed 10 luminaries, Nobel Prize winners, asked them what their perfect portfolio was. And it was really a little bit of the history of what's known as modern portfolio theory since Harry Markowitz in the mid 50s. So preparing for that book, there was a chapter that we included that was a brief history of investing going back to many centuries. And that got me interested in investment history and also some of the luminaries we talked about. There were some great stories there. And so I was really inspired, as you say, to rather than write textbooks, which I've done in the past, which really are sort of like lectures, I just wanted to tell some stories and have readers derive their own conclusions from some interesting stories.
It's such a cool thing, a cool idea. And again, I love Warren Buffett. I know we'll talk about him in a minute, but love his stories. And he has so many good teaching and investing lessons for us. But as it pertains to you, what might be your best investment or your worst investment, if you want to share one?
Sure, I can share one of each. My best investment is really boring, and I hope it doesn't bore your listeners and viewers. I have a defined contribution plan, which means I get to choose which buckets of asset classes to invest in. And when I was younger, I went all in 100% in equities because I was in a position that I could take on a lot more risk. And most of those investments were just boring, buy and hold, well-diversified portfolios. And that's really paid off over the decades. So slow and steady, diversified. We'll come back to some key takeaways. Those are some messages I'll talk about later on as well. In terms of the worst investment, this really stems from me thinking that I was smarter than I really am. And I've done a lot of research, and I'm well aware of the research on IPOs, initial public offerings. The story for IPOs typically is that day one, there's a big pop. Could be 15% if you happen to be lucky enough to get in on the IPO. But after that day one, IPO firms tend to underperform in the next 3 to 5 years. And so this was around 2006, and there was a fairly new tech stock. It had just been around for a couple of years. It had been doing quite well. And so To me, that suggested that this could be a stock ready for a fall. And so I bought some long-term puts, invested $10,000 on long-term puts. So I had 2 years for this stock to come back to earth, which I figured it would. The name of that stock was Google, and it did not come back to earth. It just continued to go up. And so I lost all of my $10,000. Had I bought calls, I would have been very rich. I did some quick calculations recently. Had I put that $10,000 into just an S&P 500 index fund today, that would have been worth about $70,000. Definitely my worst investment.
Oh my gosh, that's a lesson learned. And yeah, we always talk about the hard thing with options, which, derivatives, is that you have to be right on both price and direction and time. So you've got time and price that it has to be right on. Thankfully, you didn't go naked puts there because your losses could have been unlimited, because obviously, as we say, the stocks can go up. There's no limit to how high they can go. Which, if you're short and it goes higher, you're going to lose a lot of money.
Absolutely.
And then also you reminded me of George Soros with that quote about investing should be boring. So if you're bored, you're probably doing something right. It shouldn't be exciting. How is your investing and style, or your approach to investing? How has that evolved throughout the years?
So it's really evolved to become more passive and more long-term focused. I think I really learned a lesson, and I've become a much humbler investor now, and don't think I'm smarter than the market.
Yeah, that's a tough one. That's something we all learn. It's really tough to time the market, and it's why most fund managers, right? They fail to beat the market year after year.
Absolutely.
All right, so we can do story time now if you're ready. We'll do some stories, and I picked out a few of them. Again, your book is just all stories, and I could be here all night talking about it with you. But we also want to leave some intrigue for the viewer to go ahead and buy that book, which I really do recommend. You won't be disappointed by it. So first one I really love because it was right off the bat, right off the hop, about Cristiano Ronaldo, the world famous soccer player. And something happened with him with Coca-Cola. So if you want to just dive into that story real quick.
Absolutely. So this is back in 2021 in the European Championship, and it was at a press conference. Big sponsor, Coca-Cola. Typical press conference. You sit down, and there are prominently displayed a couple of Coke bottles. And that's what happened to Ronaldo, except what he did was he took those bottles, moved them out of sight, grabbed a bottle of water and said, agua, water, no Coca-Cola. And on that day, and this was a big headline story in the Washington Post. On that day, Coca-Cola's market value dropped by $4 billion. And so the story became one of this amazing influencer. And look at the impact that Ronaldo had. As a matter of fact, even to this day, if you check out on Instagram, he's number one in terms of having hundreds of millions of followers. So it turns out, though, case closed? No. It turns out that wasn't the story. And so there's a little technicality that happened to be going on that very day, just before the press conference. Coca-Cola, like many large companies, pay regular dividends. It's expected that they'll pay regularly quarterly dividends. They announce when an upcoming dividend is going to be. And little technicality, when at a certain date, about 2 weeks before the dividend's paid, the stock goes what's known as ex-dividend. So if you own Coca-Cola stock the day before it goes ex-dividend, you will get that dividend in 2 or so weeks. If you buy it on the ex-dividend day or after, you won't get that dividend. And so it's a regular phenomena that what happens on the ex-dividend date, the stock, any stock that is paying a dividend, it will go down by approximately the value of that dividend. And that's what was happening to Coca-Cola. And all of that happened, the drop, this $4 billion drop, happened before Ronaldo's press conference. In fact, after the press conference, Coca-Cola stock went up a bit and outperformed the market. So we really have a lot of important lessons for that. And the key one is don't confuse correlation versus causation. Correlation, did Ronaldo's snub of Coca-Cola happen on the same day that Coca-Cola's stock price dropped? Yes, absolutely. Was it causation? Absolutely not. So a very important lesson for all investors.
Just a great lesson to introduce people to ex-dividend dates and what happens. And Yeah, it's funny. There's no free lunch. As somebody that, like me, I'd say, I'm passionate about passive income, and I always say passive income's a hell of a drug. But, as we saw with Coca-Cola, that is just, you don't get anything for free. When the ex-dividend date happens, like you said, the stock will drop by the dividend amount. So all things being equal, you will have the same exact value in your investment plus the money you just got from the dividend. I love that. Just such a great way to start your book. Another one that really stood out that was really cool, that was nice to revisit, and I'd heard about this one a lot, was Sir Isaac Newton. What happened with this super, super smart guy, and how he got caught up in the FOMO?
Well, we know him as a mathematician, as a physicist. He was actually involved in Britain's currency and overseeing that. And so he was generally known as a somewhat savvy investor. Obviously, the investing market was very different in the early 1700s, but there was one stock that was very prominent, and it was called the South Sea stock. And in fact, in retrospect, we call it the South Sea bubble, because what happened with that stock is that it went from around 100 pounds a share up to 1,000 in just a few months, and then dropped back down to roughly where it started by the end of the year. Around this time, at the beginning of 1720, Sir Isaac Newton owned a lot of South Sea stock. And so he watched the stock price go up and made the equivalent of millions of dollars and sold out. You'd think that would be the end of the story, but he had the dreaded case of FOMO, fear of missing out. So he watched on the sidelines as the stock price went up and up and up. And in a panic, he went all in. Not only did he reinvest what he had cashed out, it was almost like he pushed all his chips into the center. It was probably the worst timing that he could have chosen, just before the major decline in the stock. And he's known for this famous saying that he could predict the heavenly body motions, but not the madness of the crowd. So he had experienced what many of us have experienced recently in things like so-called meme stocks that were happening in particular around 2021. And many of these stocks, such as GameStop, shot up tremendously, and those that had gotten out early went back in and lost a ton of money. So again, emotions are a common theme through history.
It happens to the best of us. If it can happen to Isaac Newton, it can happen to us, and you shouldn't feel too bad about it. I think one of my takeaways from that is the first time it happens, the first time you succumb to FOMO, it's a mistake. But the second time you succumb to FOMO, it's kind of a decision, and that one's on you. There's so many examples. One that comes to mind is Rick Guerin, who was a partner. He was early in with Buffett and Munger, and he ended up trying to maximize his returns by using a lot of leverage, borrowing money, and he got caught. He got caught in the early 70s, I think, had to sell basically almost all of it. And as Buffett says, like, he didn't get wealthy because he was in a hurry. So yeah, it can happen to the best of us. Poor Sir Isaac, but at least he didn't die a pauper, right?
He did not. He was rich to begin with. It's the classic case of how you can make $1 million, start with $100 million, and somehow that's when you'll end up with that amount.
Well, we'll go from Isaac Newton to one of my personal favorites. Everybody watching this knows I'm a bit of I guess it almost feels like a cult, like he's a cult leader, Warren Buffett. He's not perfect by any stretch of the imagination, but he has a lot to teach us. Man, if there's ever a story from your book, well, there's actually a lot, but this one feels like it could be a movie because it's got the mob involved, it's got Warren Buffett, it's got money move. It's a crazy story. So Warren Buffett actually made a lot of money, and he still owns the stock to this day. It's American Express. So delight us, Professor, with the tale of Warren Buffett and American Express.
So let's go back to New Jersey in the early 1960s. And there's an unsavory character who may or may not have had ties to the mob. There were certainly some associations. His name was Tino DeAngelis. He was a serial breaker of laws. He was in various industries, including the meat industry. But this one particular industry he was in dealt with vegetable oil, salad oil, if you will. And he owned a vegetable oil refining company. The way that this works is that he needed a space place, obviously, to store this vegetable oil. The connection with American Express, it turned out that while we think of American Express as a credit card company, and in the 60s, something, a little bit of a historical footnote, something called traveler's checks, before it was common to travel to other countries and just use ATMs, you would get something that would allow you to have the equivalent of cash in another country's currency. But if you lost it, then it would be backed by American Express as the big originator of these traveler's checks. But besides that, American Express had some subsidiaries, and one happened to be a subsidiary that owned some of these warehouses. And that's where DeAngelis had stored some of his salad oil. What happens when you have an asset like this is often then whoever owns that oil or any other commodities, you might want to borrow against that to make some other investments. And so that's what DeAngelis was doing. And so you need some kind of verification process. And that's where American Express came into play to certify that, okay, we've checked and the salad oil is there. Now he can lend against it, or borrow against it, I should say, and get a loan. Well, it turns out that what he was doing, DeAngelis, was a big scam. He was storing seawater in many of these containers, except for a little testing compartment where it would look like there was salad oil, but there really wasn't. Obviously, everything unraveled, and this fraud was uncovered in around 1963, and so the company had to go into bankruptcy. The other thing that was happening with American Express, so this was a subsidiary, and it wasn't clear whether they had to actually make good on the losses for this subsidiary that was then taken down by what DeAngelis was doing. But they made a bold statement that they were going to stand by it. The CEO was Howard Clark, a real visionary in retrospect. And the other thing which is very unusual, American Express at the time was what's known as a joint stock company. Historically, there were these joint stock companies. The big difference between those companies and the typical company today is that joint stock companies had unlimited liability as opposed to the limited liability. So American Express was not a limited liability company. And so that meant that with this subsidiary going through its problems, it was, and possible major liability, it was also possible that American Express might go bankrupt itself. Its stock price took a huge hit. So this is what got Warren Buffett really intrigued. This was in his earlier days of one of his earlier partnerships, but he was very intrigued because he viewed American Express as even in its early days as a company that had this really trusted brand. And so what he saw was really a disconnect between Main Street and Wall Street. Main Street being the users of the American Express card and American Express traveler's checks versus Wall Street, which was punishing the stock. He did some research and went around to ask people what they really thought of American Express products and the company itself while it was going through the scandal. And he concluded that American Express was going to come out of this just fine. And so he viewed this stock to be really undervalued. So he made a major decision with this partnership. He put almost a fifth of the partnership money into one stock, into American Express. And it probably was his best investment ever. He got in almost at the bottom, and within 2.5 years, the stock was up by 125%. And so really, this is the classic Warren Buffett famous saying, it's better to be greedy when others are fearful and fearful when others are greedy. Here we had a case of many investors were then really fearful of what was happening with American Express, perhaps going bankrupt. And so this was a time for him to be greedy and go all in. And it really paid off for him.
Yeah, so market overreaction created an opportunity. He took advantage of it. He did the ground. Like I think you said, he was looking to make sure people were still using the traveler's checks. Customers were still happy with American Express. And yeah, I think he saw that it wouldn't sink them. They would be able to recover. And market perception was not reality, which again, look for those opportunities, but you just can't go buy them like willy-nilly. There does have to be some legwork if you're buying individual stocks. We'll shift and segue, into somebody that actually kind of talked against individual stocks was John Bogle, the guy that's responsible for the ETFs that we all know and love, like VOO and all the Vanguard funds. So he had a quote that said, "Don't do something, just stand there." That was kind of central to your thought and a little bit of strategic tactical investing advice about masterly inactivity, which is a phrase I had not heard before. So when might masterly inactivity benefit us as investors, and what is masterly inactivity?
Sure. Well, let's talk about it first, Russ, in the context of John Bogle, or Jack Bogle, as he was known, and then we'll come back to some other fun examples throughout history of masterly activity. Really, it's simply the art of knowing when not to act. And so this is, as you mentioned, Jack Bogle started the Vanguard group in the mid-1970s and created the first mutual fund index fund. And again, going back to boring products, this is a boring product. This is a do nothing kind of product, buy and hold an index fund. And that's really captures the spirit of masterly activity. That's the only thing I have to do, and I don't have to do anything else. Where this would have paid off for investors, the do nothing strategy, don't do something, just stand there. I took a look at some data of what has happened in the over the last 40, 50 years on the worst 10 days in the US stock market history. All of them occurred in 1987, 1997, 2008, or 2020. And the one-day drops ranged from minus 20% October 1987, which I also talk about in the last chapter of the book, to minus 7%. So the average was a drop of around 9%, the 10 worst days. So imagine experiencing that and panic selling, saying, okay, that's it. I've got to do something. I can't just stand there. And so I'm getting out. What would have happened in the next 10 days is in 7 out of those 10 days, markets were up. One day it was flat. And in only 2 days did the trend continue downward, although it did correct soon after the 10 days. And so by doing nothing over those next 10 days, you would have recovered 5.5% in terms of your losses. So there's a great example of when masterly inactivity would have paid off.
And it reminds me of Nick Majuli has a book called Just Keep Buying. And I joke, I don't need to read the book now. He gave me the whole book in the title. And again, it's trying to time the market. And you've seen on the screen while you were telling that, I put on the screen about those days. There's a really cool infographic that shows what your portfolio would look like if you had missed those days. So you just, if you're in it for the long haul, you just stay invested. You don't try and pull your money in and out and tap dance like the bar of soap, right? The more you handle it, the smaller it gets, I guess. So you have a story about masterly inactivity.
Yeah, so there are a number of other stories that don't have to do with investing, but just some neat stories as well. Where the term really came from was a Roman dictator named Quintus Fabius. This is around 218 BCE, where he was appointed dictator to try to deal with this barbaric Hannibal Barca, the Carthaginian, who was one of the most prominent military commanders in history, and famously known for taking his army elephants through the Alps. Fabius had the unenviable task of trying to contain, trying to stop Hannibal. So he got, as best he could, he got an army together, knew where Hannibal was camping, and came close to that and just set up camp himself. And when Hannibal found out this, he was all ready for a confrontation. So he approached and was ready for war, and Fabius did nothing. He didn't take the bait. He just bided his time because he knew that Hannibal had a stronger army. He still needed time. Fabius needed time to reinforce the army. And so he just bided his time. And it paid off later on. Once he had a stronger army, then he was prepared to attack. And it was one of the greatest military upsets. Another fun example of masterly activity, probably the greatest boxer of all time, Muhammad Ali. And this goes back to 1974, his famous fight against George Foreman. Many of your listeners and viewers might know George Foreman from the grill that he made more money out of than boxing. At the time, he was the heavyweight champ, because Muhammad Ali had stepped out and was refused to serve in the army during the Vietnam War. He was stripped of his title, so he was fighting his way back. He was past his prime. He was, with this heavyweight fight, he was 40 to 1 in terms of the odds. In many dimensions, George Foreman was a stronger boxer and longer reach and so on. So when the fight started, Muhammad Ali's strategy became known famously as rope-a-dope. He did not engage with George Foreman, but rather he protected himself and just went against the ropes, absorbed the punches for round after round after round. And eventually George Foreman wore himself out. And that's when Muhammad Ali sprung to action. And it was, again, one of the greatest upsets as well, a rumble in the jungle. So masterly activity. And there are other examples of that, but I'll leave it there, that it often pays to know when not to act.
Yeah, I mean, and again, this is such a great quote. You don't have to do something. You can just stand there. And most often, doing nothing is the right answer in the world of investing. So emotions and investing, do you have any way that, or any advice how beginner investors can overcome any biases they might have, or any emotions while they're investing? And for me too, I've been doing it a little while, but I still get emotional.
Well, I think, Russ, there are a number of questions you can ask yourself. For example, do you get really excited when you see an investment opportunity and you're just you really put the blinders on and you look at things through rose-colored glasses? And this is often the case where we'll see what is a really good company, but a really good company doesn't necessarily mean that it's a really good investment. It really depends on what that particular company stock is priced at. So that's one thing to keep in mind. Another one is, and here's a quick survey, and I can anticipate, Russ, how you might answer this, because there have been many surveys asking individuals, how would you rate your own driving abilities? Are you above average, average, or below average? I know I'm above average, Russ, and I would wager that you would feel you're above average as well.
Yeah, I feel I'm above average. You kind of reminded me, of George Carlin. He always said, you ever notice when you're driving how anyone going faster than you is a maniac and anyone going slower than you is a moron? So
absolutely.
kind of the same thing.
I love that George Carlin quote. Yeah. So surveys have been done, and 80% of those surveyed claim that they are above average drivers. And really this gets at the heart of overconfidence. We tend to be overconfident in our own stock picking ability. And how this manifests is overconfidence can lead to excessive trading, and excessive trading can lead to underperformance. And in fact, males tend to be more overconfident, trade more, and underperform relative to female investors. So that's a huge bias. The third one we've already talked about, which is FOMO, the fear of missing out. And we know that goes back to Sir Isaac Newton and perhaps even before then. So our emotions can really get in our way. And we've got to try to park our emotions when it comes to investing.
It's easier said than done. I heard a quote once that said, if you're emotional, you're not thinking rationally. And if you're not thinking rationally, you're susceptible to manipulation and mistakes and all these things. So I think you're right. Like if we're feeling emotion of any kind, it's probably time to try and take a step back, maybe sleep on it, check ourselves to see if we're potentially doing something that could be devastating. We'll use that as a springboard to jump into some practical advice for beginners. And you talk about 3 levers for financial success in your book. So you want to touch on those real quick?
Yeah, if we step back and think about the goals that you might have, saving for education, buying a house or a cottage, retiring comfortably, we can translate those into financial goals. And really, we only have 3 financial goals, or 3 levers to achieve these financial goals. How much we save and invest, that's one. Another is how long we save and invest. And the third one is what kind of returns do we expect to get from the savings and investing? And it's really as simple as that. If we think about those particular levers, And picking up on the third lever, this is where you want to start a portfolio with some sound traditional investment stocks and bonds. And they differ in terms of both their expected return and their risk. So depending on how the other two levers go, how much you are saving and investing, how long you're saving and investing, then that will determine what kind of asset mix you might have to have. How much risk do you have to take on in order to achieve those goals? Obviously, the more you save and invest, the longer you save and invest, then you won't need as high an expected return, and you won't need to take on more risk, taking more stocks than bonds or other risky assets. And so it's important to realize what those trade-offs are. So a lot of the stories in the book try to make you aware of what some of the risks are involved in investing.
I think you're right. And we need to try to figure out what we want, what our risk tolerance is, our goals. That's why there's no one size fits all, right? Investing approach for every person, because everybody, what you want is different than what I want. Kind of a fun question here I want to hit you with. So if you could time travel, go back maybe 40 years, what advice would you give yourself?
I would say get started. Whatever age I was at, that should be when I start to save, start to invest. There's really this whole compounding is really magical. Warren Buffett talks about it, the whole snowball effect, and what your listeners and viewers have to recognize is that's going to mean some sacrifice. You have to give up something today in order to have it pay off in the future, and there will be a huge payoff when it comes time closer to retirement. You'll be much more comfortable because you started saving and investing at an earlier age.
Yeah, I was just sharing with my kids, and of course I should have had this information. The grain of rice on the chessboard, if you multiply it, by the time it gets to the end, it's an astronomically high number, but that's compounding, and you have to get started. And I tell them, I'm like, look, you don't have to like investing. You don't even have to understand it. We'll just put you in a broad-based index fund that's low cost, and just do that. But you have to invest if you want to have money in the future to do what you want to do when you want to do it. Professor, what's the most surprising thing you learned while writing this book?
Many have said this, history may not repeat, but it certainly rhymes. And I think that the most striking thing that I learned from writing this book is that human nature really doesn't change. And it comes back to these emotions like FOMO that we've talked about that have been around for centuries or longer. Basic investment principles have been around for that long as well, really understanding risk and return trade-offs.
That's why it was comforting to hear that somebody as smart as Sir Isaac Newton succumbed to FOMO. So when we're feeling FOMO, and another author, Morgan Housel, covered it same as ever. Like, it's just the human emotion is something we can almost predict, just like clockwork. Human beings are still going to have the same emotions. And then last one, do you have any, I know you kind of gave it, but I'll just ask it for you anyway, since I got it typed up on the sheet here. Do you have any final advice for beginner investors starting their investing journey?
Sure. I would say it's really important for everybody to develop an investment philosophy, which is really an informed set of beliefs and principles that are guiding your decision making. And it might take a little bit of time for that to evolve. My hope is through the book and the stories that can help you to think about developing this investment philosophy. I would also say think long term, be diversified, learn from stories, and hopefully you'll avoid those mistakes that others have made, myself included.
Beautiful. Yeah, everybody, you got to check this book out. Tell your library to get it if you can't afford it. Have your library do the heavy lifting for you. And but before we go, I got to know, are you a Maple Leafs fan?
I am a long-suffering Maple Leafs fan, and you might see a hockey stick in the background signed by an iconic Canadian, Paul Henderson, who was a Toronto Maple Leaf as well.
Yeah, I was going to ask you your favorite Maple Leaf player, so I think you gave it away. So 1967, that was their last year that they won the cup. So
always next year. Yeah,
we'll see what happens in the future. And Professor, I really do thank you for stopping on by and giving us a little bit of your time. And is there any parting words, anything you want to say before we sign off?
No, Russ, it was a great pleasure. Thanks very much, and delighted to chat.
Absolutely. Thank you so very much.